Welcome everybody. Welcome to our first YouTube live event. Let's hope all the technology works, Campbell, and that people can see and hear us. Well, at least hear us. I mean, whether they see us, it's probably neither here nor there. We've got some great questions to go through tonight. So thank you. I mean, I always say on the podcast, thanks to everyone that gives us or submits their questions. They're always really good and thought-provoking. We want to keep the discussion pretty live between Campbell and I and you, the audience. So as we're answering the concepts, as we're talking about things, if we don't explain something clearly enough or it brings up another question, let's get into it. And please submit your questions as we go. Of course, we can't answer every single question. And if it's a little bit off topic, it's going to be a bit difficult, but we'll do our best to get through most of them. Campbell and I have not discussed the answers to the questions tonight. And that's on purpose because, I think there's quite often a bit of nuance to planning and financial decisions. And what we hope to do tonight is demonstrate that nuance. So you'll see Campbell and I talking about certain topics or issues, and we might have sort of different viewpoints or different ways of thinking about things. And at least you'll be able to see that, and that's where we get to the answer. And I think that is really important because that's what we do inside our business. We talk about things, we workshop ideas, we kick some things around, and that ultimately ends up being the best outcome. I guess the challenge is when you're by yourself, you can only talk to yourself. That's, I guess, what we can help you with today. So what I will do is I'll ask Mina to share a chart, and I'd just like to sort of set the scene, sort of take you through this chart. And there's two main comments I'd like to make. The first one is that most decisions are connected. So it's not necessarily just a property alone question. Normally it's property versus lending or property versus tax. When we're talking about super contributions or anything like that, often it's not just super alone. It could be super tax or planning or so forth. So quite often the decisions sit somewhere in between these icons rather than specifically on an icon. And the second thing is that the common mistake is uncoordinated decisions. So, accountants talk about tax, mortgage brokers talk about loans, buyer's agents talk about property, but, and everyone means well, but who's coordinated the conversation between all these advisors? So that's what we want to talk about today. We'll get rid of that diagram, and maybe we'll get into the first question. Campbell, I think you're going to kick it off with a question from Christine and David.
Sounds good. Yeah, let's get into it. No, looking forward to this. Bit of a different format for us, but it's quite different to recording a podcast. You can pause and think and work through things. But on this occasion, we're just going to jump into it. So let's go with first one. So this is from Christine and David. So Christine's question is an interesting one. It's about how to approach a plan where there's a large age gap between husband and wife or partnership. So there's an 11-year age gap between David and Christine. Let me run you through their situation, give you a breakdown of their assets and liabilities and their positions. So Christine's 45, David's 56. They've got two kids, aged 10 and 8, and they're planning to retire in 2036 when Christine's 50 and David's 61. At the moment, they've got a combined income of $280,000, living costs of $100,000. Got a home worth about $1 million, a loan mortgage of about $200,000, which is fully offset. David's super has got $670,000. Christine's got $180,000. I think that's an important sort of number to remember there. Contributing both, or just for David, $30,000 per year going in, concessional contributions. And then Christine, interestingly, has a defined pension. You don't see too many of those these days anymore. That's worth $36,000 annually for life, and it starts at age 65. Aside from that, they've got a residential property in Melbourne worth $1.2 million with $900,000 debt. It's on interest only. Then they've also got a commercial property in Brisbane, which is worth about $1 million, about $500,000 debt on that. There's rent of about $56,000. I'm going to take that as sort of net rent there. $100,000 share portfolio, $160,000 cash aside from what's offsetting the mortgage. It's probably sitting in the, I think she's mentioned sitting in the offset account for the Melbourne investment property. And so now breaking our way through this, she's got a bit of a plan here. It's kind of like a staggered approach to retirement in order to support their living expenses. So she's planning in 2030 for the first 10 years, live off David's super fund. because he's older. They'll have access to his super, draw 120,000 per annum. Then after that, the next 5 years, the commercial property will be fully paid off, and then you'll have 56 grand of income from that, and then you'll draw 64,000 from Christine's super fund then. And then in the next 15 years after that, then Christine's defined pension will kick in, and that'll be about 37,000. Then with the commercial property rent of 56,000, and then draw about 20 grand odd from Christine's super fund to get to that total 120,000 that they need every year to live off. And then from that point onwards, 2060 onwards, just live off the defined pension and the commercial property rent. So a lot of information there, but there's sort of the staggered approach. But I guess her question, looping back to it, is really, how do we be at peace, Stuart, with eating up one person's super fund? Because for that first 10 years, it's just going straight into David's super fund. It's the only source of income. So how do you be at peace with eating into one person's super fund while waiting for the other person to reach preservation age? And paraphrasing here, is there any concerns or risks that you see with that plan?
Yeah, I mean, you're right. Can we hit pause and have a think about it?
Yeah.
Well, look, I guess it's challenging. It's more of a the way I look at this question, it's more of a sequencing decision and then asset allocation decision. And the first thing that jumps out at me, and probably does to you too, Campbell, is that if we run down one person's super, well, actually, as the plan that Christine's laid out, we run down one person's super, we're going to end up in a situation where we have too many assets outside of super and not enough assets inside super. And that's not ideal from a taxation perspective. I know we've done a few podcasts recently about trying to maximise the transfer balance cap. So, that at the moment, just looking at their assets, got 42% of their asset base inside super. So as well as thinking, how do we fund retirement, we should be also thinking about how do we get at least $4 million between us in today's dollars into super, because that's going to be tax efficient. And I guess the thing that sort of jumps out at me is the commercial property. It's yielding 5.7%. It's a high yielding property. It's commercial, so we don't pay many of the outgoings. So that's, free cash flow, which is great because it allows us to reduce debt aggressively. But, then we're going to end up paying tax on that. Now, we don't know the ownership structure of that property, but I look at it and think, well, can we get that in? Should we put it inside super? And then I ask, can we get it inside super? And, I don't want to surprise anyone too early in tonight's episode, but Victoria actually has a more accommodating stamp duty regime than Queensland. So this property is in Queensland. If you transfer a property in New South Wales or Victoria from your personal name into super, and so long as the beneficial ownership doesn't change, so it goes in proportionate to your accounts inside super, you don't pay stamp duty. So they'd have to think about whether the CGT limits that. Unfortunately, in other states, including Queensland, where this property is, that's not available. But we're not trying to pick holes in things. I think, it is what it is. There might have been other decisions or considerations that went into that decision. But I would have preferred that to be inside super, because at least then you're going to get the income stream. You're not going to pay any tax. And if you're going to keep that investment, you're going to get 5.6 yield. How much growth are you going to get? You probably don't need much growth, probably just keep up with inflation, and that asset's probably doing enough in terms of contribution. Unfortunately, if it's outside super, maybe the income tax is going to eat into that. I guess I don't have too many concerns necessarily with the plan she's laid out, but I guess the key element here is, what are we going to do with that Melbourne investment property? We wouldn't want to sell it today you wouldn't want to sell property in Melbourne today, but potentially in 10 years' time, you could sell it and then replenish the super balances. I don't know. What are you thinking?
Yeah, look, to answer Christine's question, I don't have any issues with drawing upon one super balance more than the other. I mean, I think super's super, for a husband and wife, it doesn't really matter. It's all about total super balance. So I don't particularly have any issues with that. I think more just the numbers around the first 10 years are probably the most concerning thing for me. So David's got 670,000 in super at the moment, 4 years until they plan to retire. Even if he puts 30 grand in per year, hopefully get some good returns. I don't know, we're talking maybe 800, 900,000 maybe in super by that point in time. going to draw 120,000 per annum for 10 years. It's kind of pushing it a bit.
Yep. And the investment property looks like it's still negative cash flow. So that's not ideal. We tend to not want that. It's okay for a property portfolio not to be putting money in your pocket, but you don't want it taking money out of your pocket. It's not ideal. You only need sequence of returns in super to go against them. So we have a couple of bad years, and then the property has a couple of bad years in terms of cash flow. It can put a little bit of pressure on.
I mean, I guess there's a little bit of buffer there. There's 160,000 in cash, which is in the offset account. I mean, that's just going to make it even more negative cash flow, that property. So it's not going to be a great feeling if you have to draw upon that. There's 100 grand in share portfolio. I guess you could draw upon that, but I don't know. I wouldn't feel, I mean, if we were working through this plan for a client, I really wouldn't feel overly comfortable. There's not a lot of wiggle room in it. I feel just that first 10 years in particular, I'd feel a bit uncomfortable around it. I'd want a bit more buffers. And, you know, we kind of build our plans with a lot of conservative assumptions in it, with some contingency in it. I'd be a little bit hesitant about this just because you really need, you know, the super funds to do very well and not have a big correction prior to retirement or straight in the immediate stage of retirement. So, yeah, it's a little bit tight for me in that first 10 years.
They've got $2 million of net investment assets, I estimated. So, and they're going to retire in 3 or 4 years. So there's probably a plan here. Like there's probably an answer. And that's why I think it's probably more of an asset allocation question rather than a sequencing question. You know, I think maybe the asset allocation's probably too aggressive for their stage of life in terms of having a heavily geared investment property in Melbourne that's negatively cash flow. So, you know, that's the thing that I'd be really thinking about if I was in their situation. The other comment I'd have is got to be really careful. These, so the commercial property has a pathology business as a tenant, which is great because pathologies, they pay huge money. I think it's part of a medical clinic, and, you know, as you know, you go into your GP, they give you a blood test, you go next door, you get the blood test. It's shooting fish in a barrel. The problem is, though, that the value is very much attached to the tenant, the value of the commercial property. And so I had a client that that was part owner in a GP practice, and they had a pathology business inside their practice, and they were paying ridiculous rent, and the practice was in their super funds. They owned 50-50, but it created a real problem because their retirement was really most of the rent coming off the practice that the practice was paying, and then the pathology was paying. So you just got to think about that. You know, if I'm going to go into retirement, I've got defined benefit, that's okay, that's guaranteed. And then I've got rental income coming from that might be paying a little bit over the odds just because, you know, there's some benefits to them. Yeah, so it's something like you can't just look at the assets on face value. I think you got to dig a little bit deeper and understand the underlying risk in those assets.
Yeah, that's like an obvious comment, which I'll probably keep saying with all of these questions is, you know, we're just looking at, okay, there's a property worth $1 million with $500,000 debt against it, but it all comes down to the individual asset, you know, because you should always part ways with an asset that's going to be underperforming, or if there's a great one, you should do whatever you can to shift things around to keep it. So, I mean, it's, you know, we don't have the time and the ability in doing this to actually assess each individual asset, but the quality of it counts.
Yeah, 100%.
And then Christine's other sort of little thing, a follow-up question here, which I'll mention is, you know, is there any opportunities to better utilise super when one spouse hits preservation age long before the other? I mean, the only other little, I'll put the question to you, but one thing I was just thinking about is maybe, look, I think the aim of the game is really getting as much in David's. I'm most concerned about that first 10 years, so getting as much in David's as possible. And I don't know what Christine's income is, but you've mentioned combined income of 280,000, I think it was. So with Christine's contributions, you could maybe, look, it's a little bit, so it's going to shift the dial a little bit. You could do some spousal contribution splitting. So what would be going into her super fund from her employer contributions, split that across to David, get it in David's to try and really boost up that 670,000 over the next 4 years.
Yeah, 100%. But I think that's the key success factor is how we're going to manage the risk, you know, around David going into retirement, drawing heavily on super, and how does that link into the other assets? I think that's the key part for this question.
Mm-hmm. Yep. Cool. All right. I think that's pretty much covered off. I think everything Christine and David wanted to ask, I think, for most part.
There was one question there Christine had about how much you need to preserve for aged care. I guess that's the that's an interesting thing where there's a mismatch in age where you might have one spouse staying in the family home and the other spouse needs to move into a higher care facility. What do you think?
I don't know. I'm not too sure about that.
Six to 800,000 is typically a lump sum that you need to pay, but you can pay a daily rate instead of paying what's called a refundable aged care deposit. I think it is refundable accommodation deposit, RAD. It depends on the area, depends on the type of facility you're going into. It's a terrible word, isn't it? Normally we preserve the family home as, we say, well, if you need to go into other accommodation, we'll sell the family home and we'll use those proceeds. But I guess in a situation where there might be a mismatch of timing, it's something that people need to think about. I don't know what the answer is because we can't magically make money appear. But if they've got $2 million of investment assets today, want to retire in 4 years' time, I don't think they're necessarily going to have readily access to $800,000 if someone needs to move into retirement accommodation. Maybe it's a case of making friends with at that stage, downsizing. Pull some equity out of the home that can go towards paying the deposit, and then go find an apartment or a townhouse or something like that.
Yeah, I think that's a reasonable approach, reasonable assumption. Yeah.
All right, we've got a next question. Listener wants to remain anonymous. We'll call him John. So he's 48, she's 50, both PAYGs, earning 140 and 125. So in terms of assets, combined super is 550, 400 in his name, 150 in hers. 50 grand of shares, a home worth 1.3 with net home loan of 100,000. Got money in offset, and 5 investment properties across 3 states. Good geographical diversification there. $4.5 million total value, 2.8 million of debt, so 1.7 mil of equity in those properties. And the first question, Campbell, is based on this: are we on track for a sustainable perpetual retirement portfolio?
How much do you spend? Is the key question, I guess. That's being cheeky there. They sort of haven't mentioned it, not to be annoying, because but it all does depend on how much you spend. But I would think, based off those numbers, let's say you need to live off 120,000. Let's just go with that. We haven't sort of mentioned, but just work off a sort of a round number there. I think you are. I'd have to do the numbers, but I reckon a perpetual portfolio is there. If as long as you're not spending, you need crazy amounts like 200, 250,000 to live off. It's pretty conservative, normal amounts. Then I think you're on track to have a perpetual portfolio. I mean, super fund's a little bit low, but you got 10 years before commencing retirement at 60. But there's good equity. If you look at I always think loan to value ratio, and I always talk with clients about, I think you want to get investment properties to cash flow neutral. I reckon that's kind of at least aim of the game. If there's no debt against them, well, great. But in order to have got to no debt on the investment properties, you have had to have paid down a lot of that debt. And I don't think the return on investment by paying down investment debt is that good. But then having said that, you've got to pay down. You can't go into with whopping, investment debt into retirement where you've got a massively negatively geared property portfolio. So I think you've got to reach that threshold. Now, it's different where that is, but generally I reckon if it's about a 30-40% LVR, loan to value ratio on investment property one or portfolio, you're kind of getting to cash flow neutral. It all depends, again, on the rental yield and the expenses and that sort of thing. And look, you're spread across 3 states, which kind of helps you a little bit, I guess, from a land tax perspective. But I think, naturally over the next 10 years, could that 60% LVR with some growth, assuming they're decent properties and you get some good growth there, I mean, that might tick up and you might sort of get close to sort of that 40% loan to value ratio just with natural growth over 10 years with those properties. So I then think that maybe they could be washing their own face, and 100 grand left on the home loan. I think, that'll get taken care of pretty quickly. And then, you've got 550,000 combined in super at the moment. That'll build. I think, incomes are, 140, 120, a bit going into super, but you're both salary sacrificing. So, I mean, that'll turn into 1.5, 2 mil maybe in super. And then you've got, a good property portfolio that might be getting round about cash flow neutral. long-winded answer, me sort of breaking it down, I think, John, but I think it's looking pretty good. But it all comes back to that about how much do you need to live off.
Yeah, we've got a couple of questions which I'll ask from listeners, but the way I do it, Campbell, as I say, let's be conservative. You've got $4.5 million in property. Let's say in 10 years' time that's worth 8, which is less than 7% growth, but let's be conservative. So you got 8 million, some selling costs, repay the debt, 2.8, and then allow for 1.5 million in CGT. That's assuming the discount is reduced to 30%, by the way, or 1/3, which I think is going to happen. Gives you about 3.6 in cash in your bank after tax. And then if super just conservatively goes from 550 to say 1.1 or something like that, that gives you $4.7 million in 10 years' time. In today's dollars, that's $3.5 million. In episode 314, I talked about a perpetual portfolio. It was about 2.7, I think, when I did those numbers. So looks like well on track to be in that situation. I'm not saying go and sell all the property in 10 years' time, by the way, and go all to cash. But, just rough numbers, that's how I like to look at it. So one of the questions, Campbell, is how do you deal with rising cost of living? Will super last as long as you think it will? Because I guess if people did the calculation 5 years ago before COVID, cost of living has changed a lot since then, right? So how do we deal with that risk?
So how do we deal with the cost of living rising rapidly? Will super balances realistically keep pace with inflation? Well, I guess you've just got to look historically. I mean, investment returns have always, across the averages, long-term, have outpaced inflation. So as long as funds are invested, there might be windows of time where inflation goes through the roof and investment returns, because they're probably counter-cyclical, like working cross paths. But I think across the long term, as long as investment balances are outperforming it. Now, how do you account for that? I guess, I don't know, you've just got to make sure your money's invested well and put in a lot of contingency and work into your plans, factor in inflation. Like when we're working on plans, obviously we build out sort of 30-year plans. We, apply, an indexation, inflation figure to, what people are going to spend. So, I mean, if you're spending $120,000 today, that's probably going to be $300,000 in 20 years' time, sort of thing. I'm making these numbers up. But so it's about thinking ahead about how much you're going to need. And I think just making sure it's invested well, because investment should outpace inflation across the long term.
And that's been true, really. If you look at share markets and property markets over the last 5 or 6 years, that they've certainly outpaced, except for Melbourne, of course. Well, even Melbourne's outpaced inflation only by 1% over a 15-year period. Big deal. But that's the thing. Can you earn a return in excess of inflation? That's got to be your benchmark. Can I earn 4 or 5% in excess of inflation? And if you're spending 4 or 5%, then you've got yourself a bit of a neutral portfolio. But it's challenging. Just be conservative, like you said, Campbell, with all the other assumptions. And some things are going to move in a positive direction. Some are going to move in a negative. You hope to be all right. I mean, the satisfaction that I can give listeners is that we've been doing projections like this for 20 years. And, except for a major change in client circumstances, they've been on the money. So it gives us a confidence from our perspective. There's another question there, Campbell, about if we've got an investment property in retirement, so no debt, and quite often people look at that and go, well, that's an inefficient asset because there's no debt. Do we sell it, and put it into shares? So to what extent, let me reframe the question, to what extent does the debt level dictate whether you should hang on to property or not?
It does, because leverage is an important element. Like, so this person's given an example where there's no debt, but in other examples, I've had people, sort of getting close to retirement thinking, this is the equity that I have, and I'm getting the property's only going up at 4 or 5% capital growth per annum. I could pull that out, that equity, and put it in share market and get 8 or 9%. And it's like, yeah, that seems right, but if it loses the element of leverage. The leverage is quite critical. And so but it's different though if there's no debt against it. And then I think if there was no debt against it, then you've just got to weigh up, well, what kind of return are you getting? How well is it performing in terms of capital growth, in terms of income and net income after expenses? And if it's not stacking up, and if it's an appropriate time, depends what the capital gains tax is, if you're going to take that hit. But I think I'd weigh it up and look at, well, I'm going to take a hit in terms of capital gains tax because it's lumpy property, as we know. take that hit in 1 year. But if you're in retirement, you don't have too much other accessible income, then it's not a bad time to take it. And there's a window there that you can do a few things to minimise that capital gains tax as well. If you can still do concessional contributions up to a certain age point. So it's things you can do, but I think no debt, then it's kind of more of it's a more simple leverage element's gone. I would just look at it black and white, assess the transaction exit costs. And I think, I personally think there's a big value to liquidity. I mean, if we had a hypothetical situation right now, in my opinion, if it was, here's $1 million cash, you're not allowed to use it to go and leverage to get more money from the bank. You can only go with cash. Would you go property or shares? I would go shares every day of the week.
100%.
Liquidity, flexibility, diversification, but property, the leverage is what really brings it into the fore. So I guess that's kind of what this question is. It's really just without leverage in it, assuming you could access no further leverage. I think you just got to weigh that up, have a look at it. What's the exit costs and value liquidity?
The only thing I'd add there is depending on market conditions. So if it was in Melbourne and I had to give it away for, 1.5 and I thought it was really worth 2 in a good market, maybe I'd hang on to it for a couple of years. But I guess when we say sell, it's not sell tomorrow. It's strategically sell to maximise value. Just leading on from John's question, remember he's about 10 years away from retirement, still in a pretty good asset position. He's asking whether he should switch his loans to interest only or keep them P&I. Of course, if they switch to interest only, he's saying, well, potentially I've got some more cash flow to invest in other growth assets.
Yeah, I would. So I think his question is the investment loans from P&I to interest only.
Yes.
Yes, I would. I mean, particularly whilst you've still got $100,000 left. I mean, I kind of think on the mortgage, that is, there's still $100,000 of non-deductible debt. There's not many instances where I think that if someone's got non-deductible debt, they should be paying principal down on the investment debt, deductible debt. There's not many instances really that I can think of. If you're going to pay down principal on something, you want to be paying down. Now, that's a perfect situation. Sometimes people get themselves in situations where they can't refinance, they can't go on interest only. They're kind of stuck in it. But if you do have that ability and you still maintain that flexibility from a broking perspective where you can, refinance and do these sorts of things, well, you've got $100,000 left of non-deductible debt. So I'd want to be paying down that principal over the investment debt.
Yep. Yeah. Great.
Yep.
On to Tom, I think.
On to Tom. Okay. Yep. Next one. So Tom gives some great feedback about the podcast. So he says, my wife and I, bit of a question here about the current climate in the market. I'll sort of ask this first question. I'll go into his latter ones. So my wife and I have a lot of anxiety about the status of the world right now, especially off the back of Trump's latest actions in Venezuela. Obviously, I reckon there's a bit of a delay
yes.
here. He hasn't even mentioned Iran, but it's probably that 2-month sort of delay in reading these questions.
I picked some questions from November, December, January and February, just randomly. I try to find some good ones, but they're all over the place.
Well, Tom, I wonder how the anxiety levels are now. So I know you take about 2 months to get to these questions and thought maybe you could comment on managing wealth and investments as we steer into some potentially difficult times, alongside your previously shared views about the market being at all-time highs. Personally, I know it's advised to not panic during the lows, but is now an exception.
Well, we were talking about this today. There's always something that's going to cause volatility.
Yeah.
It's always something different, and it always feels different every single time. But the outcomes are the same, that we see volatility every year, almost without fail, there's a 10% decline, an intra-year decline. So, whilst you might end up in the positive for the calendar year, during the year you've experienced some sort of 10% decline. And there's a major correction every sort of 5 to 7 years. And that's just the price of admission. If you want to invest in growth assets, particularly shares, that's what you need to deal with. And in property, you can experience declines in property as well, maybe not as pronounced as they are in shares. And the downside with shares is they're liquid. Well, it's an upside, but from a behavioural finance perspective, I can turn around and sell or stop investing, even worse. And so no, I think everything, there's always something different. Like I said, GFC, COVID, a war. War's pretty common actually. I don't think that's like COVID or GFC. And it's just a behavioural finance issue, which shouldn't underplay it. That's a major issue. I've got a podcast coming up at the start of next month to talk about that in terms of like I find that some clients, even people that are very successful investors, find it hard to transition to retirement because you go through a phase in life of save hard, invest aggressively, do all you can to get yourself in a financial position. At some point, you need to take a turn and say part of that strategy is spending that capital as well. So it's the same sort of thing. There's a lot of behavioural finance sort of stuff that goes on, but I think ignore it. What do you think, Campbell?
Yeah, I agree. There's always things, not to underplay the severity of what's happening in the world at the moment, but there is always things like wars are not uncommon, and neither are tariff wars, trade wars, recession fears, shortages, supply chain issue thing. There is. I looked at a chart the other day where it's almost like just consistent, the things that have happened. Once you zoom out and take a long-term view, there has been so many of these things, and really investment markets have, there's short-term volatility, but they steer through, they find another way. It's all really small blips on the radar when you zoom out. And I think what's going on at the moment, it's concerning. The share market is always very forward-looking and it doesn't like uncertainty and that sort of thing, but I think it is exactly the time when you can't pull out. And it's almost the time that you want to the most. You're seeing your portfolio going down, there's fear, but that's actually the most important time. There's an interesting data that came out, I can't remember, it might have been Fidelity that's produced it. It shows that the best days on market, talking about the share market here, not so much property market, best days are always after the worst days. So it's, the people that pull out at the worst point, missing out on the best days. And then the impact of missing is I think it's on Fidelity on their website. It goes in, you can look at what's happened if I invested $10,000 and missed the 10 best days over the last sort of 30 years, and it shows you the impact on it. It's unbelievable, by just getting out of the market and missing those ones. So it's that old time in the market thing.
Yep. And the way to think about it also is to what extent current known risks priced into markets. So you might go, well, markets have dropped 10%. And there's so much uncertainty, but sometimes all the uncertainty is priced in too. I'm not suggesting it's right now, but sometimes it's not just about that. And then the second thing to think about is, well, if I was happy to invest 3 months ago at this level, then I've got to be happy to buy on discount. I'm getting a 10% discount. And it's not about timing the market. It's about consistency. So investing regularly and invest and holding those investments for the very long term, that's the key success factor here. So whether you increase your investments during time like this, I mean, it'll probably work out well. Evidence tells us it'll probably work out well, but that's not a key success factor. It's just staying invested.
Yeah. So let's go on. Tom's now got a question about his home. So he's lives on the lower North Shore of Sydney in a 2-bedroom apartment, which he has strong conviction is investment grade. But we face a tough decision in the coming decades as we anticipate some inheritance of maybe $500,000 to $1 million coming to them. So he mentions they love living where they are, the quality of the apartment, but they know to upgrade their home to buy something that's more of a forever home, they would have to sell. Knowing Sydney prices and their particular borrowing capacity, they'd need to sell. And estimated value of sort of 1.6 with 600,000 equity. So I think what Tom's saying here is the sale would leave him with then a budget of about 2.7 mil to go on upgrade, and that would involve having to sell the home. And so interested to hear how you balance the nuance of buying the forever home with these concerns of parting ways with a great asset and fighting against the crazy prices in Sydney and falling short of a budget that would get you a great asset where you want to live. Do we run the gauntlet of trying to keep the quality of asset we have, but upgrade size for a 2.6-ish or look at something else? He's also suggested maybe we could rent vest, but he's sort of to himself, he's mentioned that doesn't really keep our current assets and we aren't utilising the inheritance. So I think really the key question is about that, weighing up, do you sell the home and upgrade it, put a lot into it, particularly with sort of crazy prices in Sydney in the property market?
Sometimes how a particular decision will play out isn't always clear, but the right decision is clear, right? So by that I mean is quite often I found personally in my life and also advising clients is that the best decision is the decision that's going to maximize your long-term wealth. So Tom needs to ask himself, what decision can I make? So in 10 or 20 years' time, I look back at my decision in 2026 and go, that I nailed that one. It killed. And I reckon there's probably less than a handful of decisions we make during our life that are those sorts of decisions, that I bought a property in the middle of the GFC, and I know that turned out to be an excellent decision. Now I didn't try and time the market. In fact, I went to the auction. I didn't think I was even in the price. I was lucky, but I think there's just those handful of decisions. So that's the right decision. But how will it play out for him? It's probably difficult for Tom to see, and it's probably difficult for us to see. To what extent does buying a really great family home help him fund retirement? Well, we could talk about some theoretical ways that could work, but will it work in Tom's situation? I don't know. But the decision he makes today that's going to put him in a great financial position 10, 20 years, I can't help but think that's going to move him forward. So I wouldn't look at it as I'm giving up an investment grade property, and then I'm going somewhere else. The way I would look at it is to say, I've got this equity in this investment grade property, and as long as I take that equity and put it in as good a property or better, and arguably, hopefully what we're doing is upgrading in quality as well, then all I'm doing is moving that equity over there. And arguably, I've got greater leverage, and arguably I should, over longer term, earn a superior compounding capital growth rate as well. And I can't help but feel those two things together are going to put him in a great position. And like I said, sometimes it's really difficult to see how it plays out, but I've seen many circumstances where people make a decision like this, and 7 years later, they've got another decision ahead of them that they can upgrade again and buy a home that they never thought they'd be able to afford. Or they get into an area and then 10 years later go, we could never buy in this area today. If we didn't do it back in 2026, we couldn't do it now, we would have missed the boat. I've seen it many times. So I think it's really just about quality. And it goes against what we talk about, Campbell, which is have a plan, have a clear strategy. So I still think that's important. What I'm saying is sometimes in some situations, particularly for younger people, because they've got a lot of runway ahead of them, sometimes you don't necessarily need to know the strategy perfectly. You just need to make a really good long-term decision today. What do you think?
Yeah, it's funny that, it kind of goes against financial planning in some ways, not knowing exactly when it's going. But I agree. I think reading between the lines for Tom, I think I'd do it. Upgrade, because property is an unfair asset class in the way that you can typically, as long as you buy right and you do it correctly, but typically the higher up you go, the better the quality and therefore better performance you're going to get from it. And, it was interesting. We were working through that strategy with a client recently. Well, not quite a strategy, but clients of ours were looking to, upgrade their home, and, they were already in a great home, but they just decided with, expanding family, they wanted something bigger, and they were thinking, should we do it? They've just paid off their mortgage. Then they're going to have to take on more non-deductible debt. And I think also as well with these decisions, at least you go into it eyes wide open, knowing, and at least we kind of mapped it out for them and said, okay, if you go and buy that, they were looking at a 5 mil property initially. They didn't end up getting it, and they bought something for sort of 3.5, but which was still an upgrade. But even with the 5 mil, I think there's got to be a value put on lifestyle and personal, I think that you get to live in that place, and, your kids are in there. And as long as I said to them, it might be likely based off my projections that I think you're probably going to need to sell that when you're about 75. And then by that stage, the kids are probably gone. And as long as you go in eyes wide open to that decision, knowing, and then once they sell it, downsize, flying, no problems, top up super, all good from that perspective. So as long as you go in knowing that and you get a good sort of 40 years old of living in that great asset, I think that that's fine. So, and I think also, Tom, I don't know if it was me, you could live your life wondering and regretting, perhaps, I feel, in a way. I think it's something that you want to do, and sometimes you've just got to stretch a little bit. And then I kind of think, what's the absolute worst that could happen? Maybe then you get to the point when you're in sort of mid-retirement and you're sort of forced into selling it and downsize. Well, maybe that's not the worst thing at all. But I think by that point, you're probably going to be put in a better position.
Yeah, I agree. I totally 100% don't underestimate the lifestyle benefits, and we've seen a lot of clients implement that strategy, notwithstanding it's helped them financially, but it's certainly moved the dial from a lifestyle perspective, which, it can't be underrated. It's not, building wealth's a journey, it's not a destination, and you want to try, we don't know how long we're going to be around, we're trying to enjoy both. That is saving and investing, and then enjoying some benefits today.
Yep.
We've got a few questions there coming through, so thanks very much. I mean, we apologise if we can't get to them all, of course. I think we've got a couple of questions around CGT and the potential changes, Campbell. And before we get into Kelly's question, maybe what do you think about that? What do you expect the government to do on budget night?
Yeah. Well, I guess the mail that we're getting, and this is, it's widely sort of covered in some in the news, but the mail that we're getting and we suspect is going to happen is a reduction to the CGT discount, and we think it's a third or 30% or 33%, so it's going to change to a third reduction. There is also talks about changes to negative gearing, but maybe the question's not specifically on that. But sticking with the CGT, I think that it's probably fair, but my kind of more thought around it is, okay, well, what happens after that? Does that then feed into allow other things to happen? Like, does that, because I think the whole intent of this inquiry, this committee that sort of presented to Senate was, it was based on the whole over-reliance of the Australian government's revenue off income tax. And it said, well, what's some things that we can look at this? And it identified that capital gains tax discount was slightly unfair or not quite, equitable in a way. But I'm thinking, well, if taking that from there, would it enable then income tax rates and marginal tax rates to be reduced to allow that overhaul? And that's the thing that I think is concerning. So I wouldn't worry so much if it changed from 50 to 30%. I know there's probably some people listening that go, oh, well, that's going to mean hundreds of thousands of dollars more of tax that I'm going to have to pay when I sell this property. And yeah, it is. But I think ultimately, if you're making a big gain on a property, I don't think it's going to change the dial for you that much. If that is, then I think you're running pretty tight, and it's a pretty tight plan with not a lot of sort of buffer in it. But my point is, I could take this hit on this if it then feeds into somewhere else and some other income tax cuts. But whether that's going to happen, I don't know.
Yeah, I mean, if they have different tax rules for shares and property, that's not ideal, because that'll change how new capital is invested. And we want more new capital invested in housing. I mean, that's what's going to improve the pressure on rentals and deal with the population growth we've got. We can talk about building new houses, but you can only do that in certain geographical locations, of course. Where there's vacant land, you can't build new houses in the middle of Melbourne, for instance. That's not going to happen. So to some extent, we need to rely on private investors to provide that rental accommodation. So I don't think it moves the dial in terms of makes property no longer attractive. Like we said at the beginning, it's really the combination of leverage and compounding capital growth. What it will do, hopefully, is make investors more focused on buying well. So buying a property that is going to generate a lot of capital growth, remembering that, one of the benefits of capital growth is you reinvest that growth each year pre-tax. You don't have to pay the tax until you sell the asset. And so mathematically, there's a big benefit of that, as opposed to getting, a greater share of your return in income. So it's not going to change it, I don't think. If they cap negative gearing, of course, people might then start thinking, well, maybe I need to have a little bit more in shares, a little bit more in property. I don't think that's a bad outcome either. I'm not for it, by the way. I think it's a dumb idea. Well, the premise of the Greens is that it inflates prices, and there's no academic research on that. And the premise is that the top 10% of taxpayers pay most of the CGT. Well, they're realising most of the capital gains. And if you crystallise a big capital gain, guess what? You're in the top earning tax bracket in that particular year as well. So it's a bit of a nonsense, but it is only a tax grab. That's what it is.
It's an interesting question here, Stu. If the proposed CGT changes are not grandfathered, do the affected property owners, or if it's not grandfathered, do the affected property owners have any legal recourse against the government? Wow.
I saw a bunch of businesses sued the Victorian government successfully for the lockdowns over COVID. Yeah, there was a big payout, $150 million or something, just added to the bill for the Victorian government, no problem. I don't think there's any recourse for that. Just on the non-grandfathering thing, it makes sense from a political policy standpoint. So, the Greens are about trying to make it a bit fairer for younger people to get into the property market. If you grandfather it, the argument would be that you've got a lot of older Australians that are then going to be paying a lower effective CGT rate, and anyone new that comes into the market is going to be paying a higher rate. And notwithstanding that, it would probably clog the market. Like people that hold properties wouldn't want to sell them because if they sold them and bought again, they'd be subject to the higher rate. I'm, again, not defending it, but you can see the thought process behind not grandfathering, which is unusual. When they change tax, usually they do grandfather. So I can kind of understand. I would not be surprised at all if it's not grandfathered.
Mm-hmm. Yep. We're getting lots of questions here. Should I do one more of them? Throw it to you. So this is an interesting one. To reduce the CGT on a property in one spouse's name, could you transfer 50% to the other spouse in one financial year and then sell in the next? Is there the arrangements? I think there used to be an arrangement where, what's it called, the love and affection rule for husband and partnership, where they could, if you'd lived in it?
Yeah, that's in Victoria, but it doesn't really apply to investment properties anymore. They sort of closed that loophole. Yeah. I guess you could partially sell an investment property to crystallise the gain. So you could, I mean, to use that listener's question, maybe you could say, I'll sell 20% each year over the next 5 years. For instance, and then gradually, shift that grain over many financial years rather than having one financial year. But you're going to pay stamp duty every time you do the transfer. That's not ideal. And the most you can save, I think, is about $30,000. So that is the difference between paying tax on the first 190 and then paying the full 47%. So there's a lot of other things we want to think about when we're selling property apart from tax. What market are we selling in? Is it a buoyant market? What does our property look like? Does our property need any capital improvements over the next period of time? Is it easy to move the tenants on? That's difficult these days with tenancy laws. There's a lot of moving parts. And then what else I'm going to do with the money? What's the opportunity cost? Do I have another home for it? Am I looking to do something with it even from a lifestyle perspective? So tax is only one of many considerations that we tend to think about. And you can have a perfect tax strategy, but if you then go and implement it in the market, the wrong market, whatever you thought you were going to save on tax, you've lost in terms of net sale proceeds. So you can't be too focused on tax. But we've never done something like that. I can't remember anything off the top of my head. Normally stamp duty is the cost prohibitive aspect of that.
Yeah. I mean, it's like we sometimes talk about people get too focused on tax outcomes from an investment. Like anything that's tax outcome, any investment opportunity that is tax outcome driven and led and advertised and marketed, it's a bit red flaggy, I think. I mean, it should be focus on great investment, and if there happens to be some good tax outcomes and benefits to it, nice, good, added benefit, but it shouldn't be the leading factor.
No, and it's exactly like the chart that I showed at the beginning of today's live stream, that often decisions sit in the middle somewhere. It's property or tax or property and planning, property and super. There's always these other considerations that we need to take into account. Campbell, let's get into Callie's question. It's a really long one, so I'm going to have to try and do my best to summarise it. But Callie's into the FIRE movement, which is financial independence, retire early, which really means save and invest aggressively so we can retire much younger. So the ages are 42 and 40, income's 120 and 80,000, super is 123 and 104. Remember, if we're wanting to retire early, we don't, we're less concerned about super balances, at least at this stage. And 80,000 in ETF portfolio. The home is worth 1.2 with about 100,000 of net debt, so not a lot of home loan debt. 5 investment properties, about 3.2, 3.3. 2.2-ish million of loans, so about 1.1 million of net equity in the investment properties. They would like to retire in 5 to 10 years and spend $60,000 a year in retirement. And so Callie's questions, Campbell, are really around constructing an ETF portfolio. And so she's sort of talking about, how do I do the transition from something that's very property heavy? Of course, a property heavy strategy is great for wealth accumulation, not so great for flexibility to reduce working hours. And so how does she make that transition in, and particularly she's mentioned a couple of ETF portfolios, I won't go through them, but pretty generic sort of diversified ETF portfolios versus something a little bit more growth with internal gearing. And her main questions are, how do I construct the ETF portfolio, and do I sell the investment properties in one hit? I paraphrase there. But.
No, yeah. So, Kelly, I don't think that it's not often that I'd recommend selling all the investment properties in the one hit. Well, I mean, particularly like from a little bit from a tax perspective, it's good to stagger them out. But even if you how many have you got? 5 properties, total value 3.2 million. Even if you staggered it across 5 years, I don't think I'd do that either. Generally, I think it depends on the quality of the asset. So, I mean, I'd naturally, if there's going to be a progressive staggering selling down, I'd try and space it out as much as possible. I wouldn't run it so that you're running down to your last dollar or even your last $100,000 in your share portfolio or your super fund. I think you've got to leave like a good sort of 3 years, 4 years window, because what happens if the share market drops, or if what happens if a particular property is just entering into a growth cycle. So a lot of buffers, but I think stagger it out as much as you can, but not till you get to the last cent of needing to sell it. I'd generally look at selling worst property first, keep a long one for longest. And I think with 5, I'd think that you should be able to hold. And so it's a progressive staging. It's sort of selling, paying down debt and improving liquidity. And each time you're doing that, and it should be, I'd guess by the end of it, you might have 1 or 2 sort of debt free, and you might not even want to get it completely to debt free. I probably wouldn't, but you're just getting it to a point where if I could get it to the point where I've got really good liquidity in selling a couple of properties staggered over time, and then you're getting the remaining ones that are best quality ones, and there's enough debt on them so that they're about cash flow neutral, and you can just hold them and they'll continue to grow, and you feel as though they're good quality assets, and then you've got plenty of liquidity around it. I think that'd be the best arrangement, but I wouldn't just go hard all at once. And I think you got to think about property market cycles as well. I don't know where these are staggered across different states and that sort of thing, but what happens if you time that wrong, if you do all of the ones in the one state at the wrong time, and that state enters into a growth cycle. So no, I'd take your time with it, stagger it out. Don't leave yourself running down to your last dollar, but I'd try and space it if you think they're good assets.
Yeah, I think so too. I'd actually, if she's 5 to 10 years away from retirement, I might even think about, it depends on the situation, but not even selling anything until the first year of retirement.
Yeah, sure. No, totally. Yeah. I agree. Yeah, I was thinking in retirement. Yeah. Until then, build.
Yeah. The transition to more liquidity doesn't have to happen overnight, I don't think. And you want to be really deliberate about it. What about constructing the ETF portfolio?
Yeah, look, I see what you've put in here. Look, it's pretty sort of basic. So Kelly's sort of suggesting, they're all market cap weighted indexes. So we've got an Aussie index, so roughly 35% in that, a global index, 50% in that, and then emerging markets about 10%. That's all right. I mean, in terms of asset allocation, I'm probably swinging a bit more to international. I like 10% emerging markets if we're talking current state. I'd be going more global than Aussie, like a 37 to 53% split of Aussie to global. I'd want more global on it, really. And I think especially for the next 10 years, because, you think about the how the components of returns come from. I did a podcast about this, a few weeks ago, about comparing the Aussie market versus the international share market, and the returns come in a different way. The international market typically has more capital growth, less income. Aussie markets have historically been made up more of income and less capital growth. But the actual overall performance of both long term is actually quite similar. But then in terms of where you want from a tax perspective your returns coming from, you'd want capital growth for the next 5-10 years. So I think that's where you focus on. And going abroad, there's more diversification as well, and I think possibly a little bit of a better outlook as well. So maybe a bit more of an uptick of that. But then in terms of your underlying holdings here, it'll work, but they're all market cap weighted indexes. So that's what that means, market cap weighted indexes. That's traditional indexes. So S&P 500, the ASX 200, it's like that. So it's the holdings are a portion based off the market capitalization, the size of each of the companies within the index. So we've been talking for a while about how we've got some concerns with that, particularly in the US and then in Australia also somewhat as well, whereby it's becoming a real concentration risk. Think of the Magnificent Seven in the US and that sort of thing. So there's in certain market conditions, a market cap weighted index is great, and if the conditions are right for that, you can just let it run because they're the cheapest as well. If you talk about fees, Vanguard, things like this, they're the cheapest indexes to hold from a fees perspective, and they're quite simple. But I don't know. I think in this current market conditions, I'd be putting some other things into it. And I won't sort of go into detail about perhaps at the moment. But then she's also recommended sort of another bit of a breakdown, which then just includes some gearing. So there's some internally geared ETFs. I really like these. I mean, I'm a fan. You know, people need to be aware of what's happening with them, but they kind of have they range in internal gearing from maybe 40 to 60% typically. And as you can imagine, just with a gearing element, it just amplifies or exponentially shows out the returns on the upside and the downside. So you just need to be aware of that. But I like it if you're a long-term investor, I don't think there's anything wrong as long as you understand what you're getting into, doing an internally geared ETF, because the maths is that the share market goes up more than it goes down over the long term. And so if you add gearing into it, it just amplifies the returns. But you need to be able to stomach it. And particularly at the moment, it'd be pretty concerning. I had a look. I've got a couple of geared ETFs in my portfolio and they're getting smashed around at the moment. But as long as you can stomach that and you're in it for the long term, they should mathematically and have, in theory, perform very well. So that's what I think about gearing. What was the other question? Was it another question?
No, that's really good. I might have a shameless plug for my new book, Wealth by Design. I talk about a value-aware asset allocation approach. So in terms of constructing an ETF portfolio, so there's sort of three components that are going to drive return when you construct a ETF portfolio. The first one is the quality of the underlying index. So by that, I mean, is it a geographical market index in terms of let's invest in Europe? And then what sort of methodology are we using? Are we using market cap indexing? Are we using fundamental, dimensional, quality? At the end of the day, the index we use, we should be happy to own for the rest of our life. That's the test. That's kind of, I mentioned in a recent podcast, the forever test. Don't go for an index so you go, well, I'll hold it for now. Like I'll try and take a position on the oil price or the gold price. I'll hold it for a little bit of time. It might work and that's great, but that's going to be probably due to luck more than anything else. So the quality of index. The second component is the price paid. So at what cost am I buying that index? If I'm getting into an S&P 500 index, I'm paying 23, 24, 25 times earnings. That chances are my future returns aren't going to be great. But if I'm buying an emerging market index at 12 or 13 times earnings, and these are real examples, then probability is my return will be good because your return is going to be made up of your income, which obviously dividends, the repricing effect, which is the mean reversion effect. If I'm buying something at 12 times and its intrinsic value is 18 times, I'm going to get a massive capital uplift. And then just the general underlying growth, the economic growth in that index and the companies and the productive value. And that really goes to earnings growth, very strong earnings growth in the US, pretty ordinary earnings growth in Australia. That's why you hate the Australian market, Campbell. Mm-hmm. And then the third element is time in the market. So buy a really good quality index, buy it cheaply and hold it forever. That's how you construct an ETF portfolio. I'm going to do a podcast towards the end of April about it, so go a little bit deeper to it. But, I guess then you've got to work out, and I think I saw a question earlier today about, well, what's the difference between going for a diversified ETF that's, sort of pre-mixed for you, probably mostly market cap indexing versus this approach? I don't know the answer to that question yet. I'll delve into it. But
one of the things I think about, so diversified ETF, it's got, X amount of Aussie, international, emerging markets. So it's all of it within it. It dictates that asset allocation within that investment option. Whereas if you construct it yourself, you get to dictate that. But then that's an obvious statement, but then you can change that as you like over time. So, the way that we like to manage portfolios is, don't just do dividend reinvestment, have the cash pay out, because then it, with regular contributions and the dividends being paid out from the existing shares, if then the market conditions look like, well, it's much better to be going emerging markets or go to Europe or US or global or Aussie or whatever it is, you can shift and move your portfolio over time with it. But with those ones, I think it's pretty preset. There is the ETF provider, the manager they have professionals in there that are determining that asset allocation, I guess. But But I think full flexibility and then having more income and being able to reweight the portfolio, you get to do that yourself.
Yeah, I guess if you go back to those 3 rules, a quality index at a cheap price, hold it forever, you're only probably doing maybe 2 of those things. You're just buying anything at any price. Like, you're going to put 35% in the Aussie market, irrespective of whether it's attractively priced. And it's a bit of a dumb index. I don't know if I can say that, but because then you're just going, well, I'm just going to follow. And I know they do manage the asset allocation. They might be slightly underweight Aussie, but they're not going to really move too far away from the general idea. And that was the key message in your recent podcast, Campbell, is that why are we putting 35-40% of our portfolios in the Australian market, particularly at a time where you can't really see where the return's going to come from. It's either materials or financials, and neither look that compelling at the moment. So if we weren't living in Australia, would we do that? The answer would be no. Universally no. So then why are we doing it? Given we can be global investors, we don't have to be Australian-based investors. I'm conscious of time, Campbell. I know it's well past your bedtime.
Yeah.
So
Yep.
There's one question, or maybe we'll take a couple, I'm not sure, but pros and cons of selling an investment property to debt recycle. So what I take that to mean is sell some investment properties to reduce my home loan. I've seen some clients do this. They might liquidate their full investment property portfolio, particularly if they've made a significant upgrade in the family home. So you can think about something like $1 million or $2 million worth of non-tax deductible debt. Why don't we sell some investments, clear that debt, kind of start again? What do you think?
Yeah, it could be appropriate and it could be a good move at certain times. The things I'd be thinking about are, well, you're deleveraging yourself. I think it's just often that missed element of like leveraging, something being leveraged up and getting a 4 or 5% return from the investment versus getting a 10% return unleveraged, probably about the same thing. I'm making the numbers up here, but the performance can be lower with the leverage element. So you're deleveraging there, but then there's benefit then in, I don't know, hypothetically someone might be restricted in terms of they've got too much debt, so they can't refinance. They don't have good, they can't go seeking other options and restructuring debt. So maybe, a pro is that, reducing debt gets you back within your serviceability level and have better flexibility from refinancing. And look, I don't know, is it sort of paying it down and then debt recycling into it? It all sort of, I don't know, again, it just comes back to I'd have to map out the performance of the assets. I know it's a bit of an annoying answer that I keep coming back to, but really any sort of like black and white thing is, you might be really highly leveraged, but if we think they're great assets, we'd go, let's work out a way to hold on. Let's work out a way to hold because that's going to work out better. But then you might even have a very, very low leverage position and might just have a little bit left on the mortgage kind of thing and be a dud property, but we go, no, I think it's still worth selling it and pay off the mortgage and do that. So, yeah, I don't know.
I can't help always thinking in these situations, it's not black or white. There's got to be something in the middle. Why don't we just sell 1 or 2 investment properties or one, rather than everything? It seems like a pretty aggressive move, which doesn't in itself make it mean that it's not a good move. It could be, but I'd just be really cautious about it. I've seen some people do it. There was a very well-known buyer's agent maybe about 10 years ago. He did that. He aggressively invested everywhere, then bought this really big house, and it seemed worked out for him. So I've seen people do it, but I think it's pretty aggressive, isn't it? There's another question there, Campbell, not really about Brisbane and Ipswich, but I think it's really about, the question is, given geopolitical tensions and rising oil prices, could Brisbane and Ipswich property markets be impacted, and is now a good time to buy or sell? So I guess I read this question as, to what extent do those geopolitical tensions have an impact on property prices? And let's reframe that question as long-term property prices, because who cares about the short term?
Yeah, that's right. Short term is now a good time to buy or sell. No different to prior to what's going on with the oil tensions and oil prices. So, is it a good time to buy or sell? Neither. But what impact does it have? It would take a long time, I would think, to trickle down through. Because if I think about it, oil prices primarily impact business, like corporate, through it's one of their key underlying, and we see how multifaceted and underlying it is for so many businesses. It's very wide reaching. And so because it's one of the very base level input expenses into so many different types of businesses in the economy. So it feeds into business, and then business being impacted can flow through into demographics, economy, local economy, which can then feed through into property, in my view. So it's a trickle-down approach. So yes, it can impact it if it's long and sustained, and it has enough of an impact that it will impact businesses, impact local economies, demographics, and then less demand for an area because the business is being pulled out of that area, therefore property prices, less demand. So it could. I think we're still a fair way off that. I wouldn't be too concerned about it just yet. What do you think?
I don't. I mean, I guess oil prices could create a recession, global recession, like if they were high enough for long enough and curtail growth, and and then if unemployment rises, that's not good for property prices. Although the labour market is really strong in Australia, so I think it could actually use with a bit of a increase in unemployment. Really, that would help with inflation. I don't think it's going to have any impact whatsoever. Supply and demand. It's how much vacant land is in that area. What is our population growth? Everyone needs a house to live in. Invest in locations where they're less sensitive to income, changes in income, for example, interest rates, these sorts of things. So they've got other sources of wealth, and in the long run, they're going to do really well. So I wouldn't worry. I mean, our answer was to the other investor about investing in the market at the moment when there's tensions going on, there's war, there's all these sorts of things. Just keep making good quality financial decisions. Buy something that's a good quality asset for a fair or cheap price. Hold it for the long term. That's the easiest way to really build wealth. Mm-hmm. So I shared that chart, Campbell, at the beginning, and I'll share it again. Like that whole idea around today is to try and demonstrate that a lot of decisions sit in the middle of each of these facets. It's not just property, it's not just super, it's not just building wealth. It's not just lending. They tend to sit in the middle or cross the middle, a lot of these sorts of things. And so we'll get rid of that chart now. But so really that's what we do at Pro Solution. So a lot of clients, begin their relationship with Pro Solution either through the mortgage broking or through tax. But our goal is the same. Our goal is to connect those dots and make sure that if our client says, I'm going to buy this commercial property in personal names, have we thought about self-managed super? Have we thought about those sorts of things? We don't want to overstep our mark, but and then as they grow their relationship, we can grow into a sort of private office arrangement where we are responsible for connecting those dots and have these conversations like we have had tonight. So I just want to thank you, Campbell, of course. As I said, it's well past your bedtime. Mina,
Pleasure.
who's been behind the camera doing a fantastic job. Yeah. And Marianne, who's helped organise everything as well. And, of course, you, the listener, that have shared their very valuable time listening to us. Hopefully, if it's successful and we get some good feedback, we'll do it again. And certainly keep those questions coming through the podcast. I've finally finished the 2 books that I was writing. One will be out mid this year. The other one will be out mid next year. It's a long lead time for that one, but I look forward to sharing them with you. And Campbell and I look forward to joining you on the podcast in the future. So thanks very much.